Today for this meeting. For those that want a copy of the slides, we can send those on afterwards via a mailing list. In terms of the mechanics of how the GoToMeeting works, if you've got the pane of the navigation in your way of seeing the full screen, there's a small set of arrows where you can minimize or shrink the and that move off the screen so that you have a screen visible to you. There's a small chat box up on the right-hand side in your menu, and if you want to pose some questions, we're going to do a Q&A at the end. You can put your questions in there. We have time left towards the end, and we have quite a few questions to get through here today, so we'll see how we go. But please pop your questions into the chat box there, and we will try and respond to those or leave time for those at the end. Right, today is Hedge Fund Association series of webinars under the title Cost Containment. So for today, it's around strategies of how to maintain profitability in the face of economic turmoil or uncertainty. We go to. So this event today is being sponsored by aXpire. And just to give you a bit of background information about the Hedge Fund Association, it's a not-for-profit organization represented in 5 continents. It's serving the wealth management, hedge fund, private equity space, and it's got a growing international membership. You'll see on the next screen where you're able to connect to our website and look at our details and look at considering joining as a member. There's lots of benefits, and we recommend that you consider doing that. Our domain is at the lower portion of the screen here. I'm going to introduce my panelists, and I'm going to let them give you a quick bio. So we have today Josh Stone from FundsLawyer and John Cavalier from Cohen. Josh, would you be giving us a quick resume and an elevator pitch?
Sure. Sure, thank you. And if there's any issues with the audio, please let me know. But I'm the principal of FundsLawyer, PLLC. We're a law firm focusing on private funds and family offices. We perform projects on a project-by-project basis and also serve as a fractional time outsourced general counsel to head up firms' legal functions. Prior to that, I worked at large law firms starting in New York and then later in Miami, and also spent 6 years as a general counsel and chief compliance officer of a hedge fund that eventually wound down, which inspired my vision of starting the FundsLawyer business to serve as an outsourced general counsel to smaller funds that might not need somebody on a full-time basis. And I just want to express that I'm grateful to be here, and thanks to the HFA and also to the sponsors and to all of you who are attending.
Thanks, Josh. John, would you say a few words for yourself, please?
Yeah, sure. Good morning, everyone. My name is John Cavalier. I'm a partner at Cohen Company, which is a regional tax audit advisory firm. I oversee our management consulting service offering out of our Cleveland office. Been in management consulting for about 10 years now. Previously with Deloitte Consulting, started my career in consulting at the tail end of our last major economic disruption. So I guess in some ways this feels like my career has come full circle. In my consulting career, I've been leading clients through large-scale back-office transformations, addressing their entire back-office operating model, technology, organization talent, process governance, and have worked across virtually all industries, including financial services. I've been doing actually a number of these webinars over the last 10 days, believe it or not. A diverse set of people, and it's been, kind of fun, even in these challenging and ominous times, to hear the different perspectives and concerns and questions from folks. So I look forward to the same from this group. Happy to be here.
Yeah, great. Thanks, John. So just things, everyone. Got a few questions. I'm Gary Markham, Chief Executive of aXpire. We're your sponsors here today. We run a FinTech company that services the hedge fund administration space with allocation, apportionment, expense management, shadow NAV reporting, and other platforms which really go towards, I guess, automation and digital transformation with a goal to cut out unnecessary costs, remove human manual processes, and basically automate as much as we can in order to drive ROI and cost benefits to the business, to get them to focus on what they're really trying to achieve at the front end of their business. We tend to operate in the mid-office, back-office area, but we are growing out our platforms, moving more towards what I call a digital funded journey, albeit some of those are our clients as well. So like John says, we've been around for long enough to remember the GFC, global financial crisis, and what that did to the economy. And it's interesting to note that I think companies tend to begin to tighten their belts and look a little bit more inwardly when profits aren't necessarily flowing in the way they were even in our short-term memory just a couple of months ago, and things begin to look a bit less rosy. So it's always a good time, I think, to focus on cost, whatever that may mean for you as an organization or an individual in an organization. So with that said, we've got a series of questions to plow through today. The overall timing of the session today is 5 minutes. I'm going to try and keep it to that. I aim to keep it to that. As I said earlier, we can maybe have a quick Q&A at the end, but I'd like to spend time elaborating on some of these particular points here. So with that said, I'm going to kick off with question 1, which is, what's the impact of the turmoil in our industry, and which players do you think will be most affected? So with that, I'm going to ask John to kick off here.
Yeah, sure. Looking across a lot of different organizations and then talking to clients and prospective clients, certainly what's evident is some organizations were more prepared than others in terms of having robust business continuity plan in place, having the infrastructure and operating model to support major disruption, although I don't think anyone can anticipate it to this extent. These organizations have been, positioning themselves over the last couple of years, being proactive change agents, investing in digital automation, building scalable virtual work environment, and trying to, at the same time, avoid becoming a bloated, hampered by inefficient decision making. But when we look at that, though, at macro level, this is the far right end of the proverbial bell curve. Gartner, just their recent survey, and showed that just 12% of organizations fit this profile of being prepared. So we have far more organizations that are trying to figure this out at the same time, and we know that's difficult. It's the building the plane and flying it at the same time. And so I know we'll get more into that, but I know that's the challenge that a lot of you are facing right now, and some of you probably have been proactive, but still maybe not anticipating the magnitude of disruption that we've seen.
Yeah, some good perspectives there, John. Thanks. And Josh, what's your views on this particular area?
Sure. In terms of the industry impact, I'm sure that there will be winners and losers. We're seeing some of the winners mentioned in news articles. People who, from an investment perspective, have had decent returns through, or even were positioned to have very high returns during this period. And then there are those that you hear about that are going to wind down, and I think that what separates the winners and the losers to a certain extent is if you didn't capture the upside in the last 10 years or so, but you did capture the downside here, and when the markets decline, it's a tough thing to explain to your investors. And this is true both within a firm, so specific employees within a firm, and also the firm itself, explaining to investors why the message was, hey, we may not capture the upside like an ETF, but you're well positioned and we're defensive in terms of the downside. They're going to be lower AUMs, both because of market movement and because of redemptions. They're going to be lower management fees. Some firms will have a loss carry forward that's going to be hard to overcome, and maybe employees will, from some of those firms that have high loss carry forwards, are going to leave or spin out. I've heard anecdotally that there are some people that are eager to launch funds during this period, and they see this as their opportunity. And maybe some firms will become a family office if they say, well, our high water mark is going to result in no performance fees or very little performance fees for the next few years. Maybe we close the firm to outside money. And so I think that firms are being squeezed. We hear about higher margin requirements and also redemptions coming in at the same time. And so I'm sure that firms are managing this, and it's a day-to-day thing. I'm sure that redemptions are coming in for Q2, and those notice periods are going to be, or have already passed, or they're going to be coming up shortly. And there are a lot of investor communications of trying to get people to keep their money in, and some funds will have to think about whether their portfolio will be viable at a much lower AUM. And so it's a continuing story, and it'll continue to unfold in the coming weeks. Also, there's a potential resurgence in the interest in hedge funds, especially those who have been defensive and have met their mandates. People may shy away from more passive strategies and invest in more active strategies. And then there's also an unknown about employee preferences, and there are lots of issues surrounding employees within these organizations. When will the employees come back? Will they want to go to their office space in the downtown areas? Will people work remotely for the longer term? Will there be layoffs? I'm sure that people have heard of layoffs already. And it's possible, and just speculating, that this could even spur certain firms to look to relocate to places like Florida or Texas that may allow them to cut costs, while at the same time moving to a place that maybe present a different lifestyle.
Interesting perspectives there, Josh and John. Yeah, just to chime in over the top, you see a slide in front of you now with some global sort of metrics, at least some of them about a week old, out of Johns Hopkins. We've seen things like stimulus packages. Talked to a lot of folks in and around the industry, certainly pundits, but also some experts that indicate that there might be some other stimulus dollars coming down the line. I even saw an article today or LinkedIn, we should be trying to make a claim against all the economic fallout from the misinformation at the beginning, but let's see how that plays out. But certainly looking at, say, the S&P 500 against hedge fund performance, and we took some recent information from the Wall Street Journal just of yesterday, indicates that the hedge fund industry seems to be weathering this storm better than the stock markets. The main indices are getting much more and hedge funds seem to be in a better position. So we have an 8% drop if you look at hedge fund research based on S&P, which is hovering between 20 and 25%. So theoretically, the hedge fund industry is actually weathering this a lot better. Some of the players that we think are going to be more impacted here are in the service space, service providers, vendors, whatever you want to call them. Anything from a law firm to a fund administrator. Those that serve the industry, I think there's going to be a lot of renegotiations going on in terms of terms. If you are basing your revenue on BIPs or a percentage based on the AUM under management, the assets under management, then you've already seen a big hit to your gross revenues. So with fee compression, not a novelty, nothing new, certainly in the fund administration If that continues and we see these renegotiations of terms, then, you know, with pressure on the top side, you have to start to your operating model a little bit closer. And we'll come to a bit more detail on that as we go further down the line. So I'm going to move on to question 2, and this is more specific about what areas of cost containment should businesses address? What are the focal points that we should be looking at? And Josh, I'm going to ask you to step in first, please.
Sure, thanks, Gary. And as you just mentioned, this is a good opportunity to evaluate your service providers. What is the cost of the services, and what's the value that they're delivering? And take a look at others in the industry that may be that may be lower cost or present something more. And so when markets are up, maybe people don't think about it quite as much. But now that there's an opportunity to take a look at your costs, I think it's also an opportunity to take a look at the value that people bring. Can you count on them? And I'm sure that the professional advisors, including lawyers in my industry, will be asked to share the pain to an extent. I'm sure clients will be even more fee sensitive than they have been. You know, there may be other areas that you can take a look at in terms of saving costs, including real estate. People are renegotiating leases, and I'm sure that will only continue. Also, as I mentioned before, one other area that you could consider is thinking about your domicile, both in terms of your fund and in terms of your management company and the costs, everything from entity formation to and ongoing costs associated with where you're located to the tax situation in both the places that your funds are located in and where your management company is located.
Yeah, certainly domicile is an interesting one, which has been an issue for the last couple of years since the variance between, let's say, Northeast New York and places like Miami. To see the model here, step number 1, putting the handbrake on, or pulling the emergency brake, so to speak, and breaking the glass to do. I've seen a lot of companies doing that right across the board. And then stepping back and looking at not just the low-hanging sort of fruit, I call it that, the low-hanging fruit in the cost bucket, but also what do they need to do in terms of contingency planning, and what could that do for their, what's the impact of that? Negotiating leases, we're seeing a lot of that. Negotiating deals with vendors and suppliers, seeing a lot of that. Looking at my internal case, really, this is far more impactful in terms of the measures the companies are taking, we believe, than what happened in the GFC, which was more of a very quick, huge global impact that really impacted the lending market, obviously people's leverage. But this is the employment numbers you will have seen over the last couple of weeks in the United States is a strong indicator. The largest single unemployment insurance claims that have ever been made in the history of the country. And I don't think that's unique to the U.S. either. That's happening in many, many countries. But certainly areas of cost, I think we've looked at that a couple of times here. Certainly your internal costs, your on costs, and then your fixed costs, which are going to be those that you have to renegotiate. There's going to be a lot of legal action, Josh. So maybe, in fact, you might benefit from this as opposed to being one of the ones that's scrutinized. But even in the professional services, we do know the legal world and the auditing world are being looked at quite heavily. So to me, I think it's in both the internal and the external costs that you're going to be focusing most of your attentions. And John, your comments here?
Yeah, I mean, the one thing we've been telling all of our clients and anyone else who's listening is that, there is going to be cost cutting. There needs to be, in some regards, it has to be for survival cost cutting, but to not throw the baby out with the bathwater. I mean, making informed decisions, things like IT costs. This is a time now that more than ever to make sure you have IT security in place, because there's more risk than ever with people, remote workforce. It was only a matter of a few weeks ago that the biggest issue for our clients was labor. You had negative unemployment rate in finance and accounting type of functions, and so making irrational cuts of heads, and not only to be back in the job market again in a few months from now, potentially hiring again, that's an expensive move, and again, it could be a large mistake. And so we've been really outlining kind of a 5-step process for our clients that's not totally that different from what's being shown here. And the first is really just understanding the current state. There's a lot of organizations that don't understand from a day in and day out basis, what is our cash flow and liquidity position? What is our cash flow coming in? What is our cash flow going out? And building that, looking at your data and your reports and make sure those are sufficient, that you have that good visibility, and then look ahead and have the scenario stress test models to see, depending on how long this goes, depending on other things that could impact, where may we run into liquidity problems. And only after that, you have that visibility, then start to explore, okay, what are the levers that we need to pull? Whether it's labor or non-labor SG&A, some of our fixed costs, real estate, then you can start to make some informed decisions, and some of those decisions may not provide immediate cost savings. I mean, even the labor piece, if we're going to part ways with some long-term employees, that may actually cost us much more in the first month through severance and outplacement costs, and we may not recognize those savings till several months from now. So just having that visibility, being able to model that visibility and have full put that strategy in place is what we recommend.
Great, thanks, John. And then taking it around or pivoting it over to more of a technology spin. Next question is, how can intelligent automation improve cost containment? And John, I'm going to have you step up to the plate on that one first.
Yeah, so intelligent automation is something we've been focusing on at Cohen for a couple of years now, and even before that, my days at Deloitte. It wasn't that long ago, 3 or 4 years ago, that only the largest organizations, your very large, whether hedge funds or your Exxon Mobil's or Walmart's with giant global shared service centers, were looking at automation because it was complex, because it was costly, a large investment to make. Fast forward a couple of years, this is technology that is here and now and can really serve a variety of different processes and have huge return on investments. And it's really fundamental coupling labor with productivity. So like I said, 4 weeks ago, we were talking with clients about automation because they had open positions that they could not fill, that were impeding their ability to bill clients, to collect, to manage cash, to apply cash, all these really transactional type of activities. And now today, why are we spending so much money on these kind of mundane transactional activities? There has to be a better way. And again, it's intelligent automation. So it serves both, in good times and bad times. I mean, it should be kind of a fundamental thread that's in the operating models of organizations, particularly in the back office. But the thing that I will encourage organizations, because we've seen countless case studies of organizations that invested a couple of years ago in intelligent automation tools and have kind of pushed them out in a federated model, and now they look back and didn't have a real vision or strategy or business case of why they were doing it. And they look back and they say, what value did this really provide? If you didn't have a business case, if you didn't have a set of objectives, it's really hard to quantify what gains we've had. So before kind of jumping into this automation journey, which no doubt about it, there's hardly, when you talk about back office optimization, a better ROI, but still have the vision, have the roadmap. Understand what is this going to change, put the governance around how decisions are going to be made in terms of prioritizing, implementing automation, make sure communications, change management's accounted for, and have that workforce transition plan. Because organizations, like I said, they've looked back and they might have displaced a lot of capacity, but if they haven't figured out what to do with that capacity, how to monetize it or redeploy it, there really is no value that was actually achieved.
Yeah, that's a great perspective, John. I guess from a similar angle, we come at this as well with, again, most of our focus on the mid-office, back office. even understanding the correlation between the human effort that's currently going in to manage a business and how efficient that operating model is today, just getting to that is quite a challenge. So I think taking baby steps to look at mapping that out, as you said, making sure you have your roadmap, and then picking the points in the process or points where if there's weakness, and look, you can not only just replace, for want of a better word, humans with machines or automation, is how can I then leverage that automation to do, a far greater effort and pulling more of the weight than I did the way I had it before. So automation simply isn't replacing humans with robots, like robotic process automation. There's also, it creates an entirely new opportunity for the organization, like you said, to leverage that, look at other revenue streams. So lowering costs is great. We're talking about here cost containment, but there can also be an upside to that, which is more around by implementing that technology, I'm actually leveraging it to the point where I can actually generate new revenues that were not otherwise realizable. And Josh, you want to chime in on that one?
Sure. Just from a compliance perspective, putting on my compliance hat for a minute, just building upon what you mentioned about not only replacing people with machines, but I think intelligent automation is important to be able to identify patterns and anomalies, especially when people are working from home and people are not in the same office. It may be harder to kind of keep your ear to the ground and know what's going on. Intelligent automation can certainly help generate reports and flag things that a person taking a look at might not see it. It may be a needle in a haystack, but a computer might catch a pattern or run a report that a compliance admin person, for example, might not catch. And so I'd encourage people to speak with their peers in the compliance space and find out what other people are doing to run reports and whether there's existing technology that can help them to streamline the compliance process while keeping quality high and even potentially catching things that people wouldn't catch.
Thank you, Josh. Thanks for that insight. We're going to jump on to question number 4. I'm going to kick this one off. Will FinTech Spend continue? Will the spending continue? So we're looking at a Forrester research forecast here, starting off in 2016. You can see a little bit of tailing off, but if you look at software as it's been growing, and even though it might look like it's flatlining a little bit from 2018, but the overall gross numbers, if you aggregate all of the elements involved in what we'll call FinTech Spend, we're talking nearly $3.6 trillion here. That's a significant indicator that automation and other forms of FinTech are being leveraged to really enhance both revenues, but also to contain costs. John, I know you've got a few words on this side, so I'll hand over to you.
Yeah, I think it's going to continue to. We're going to see, spending certainly continue, but the breakdown of that spend may be changing. How organizations are prioritizing spend. I mean, certainly, if you're going to be investing in some fintech, whether it's software, communications equipment, I mean, there's going to need to be a really clear business case. It's going to, for the most part, need to either, help facilitate the remote working environment that is probably here to stay, at least in some regards, going forward. And there's going to have to be an ROI. And so these massive type of large scale technology transformation projects, those, organizations are not going to be looking at those. It's too resource intensive from a cost and labor perspective. But things like intelligent automation, OCR, NLP, RPA projects, data analytics, process mining, niche process solutions, around BPM, like a Flowcast around financial close, or Kiva that are around stat reporting. Just a couple examples. I mean, these are things that are relatively inexpensive, relatively quick hits, and have, clear ROI in terms of being able to, reduce capacity or increase capacity by reducing manual effort being spent on some of these transactional activities. And like I said, still, there's going to be, I think, more and more investment in infrastructure to allow for this virtual workforce that we're going to continue to see for, I think, a long time, if not indefinitely.
Thanks, John. And Josh, have you anything on this one?
No, I mean, I think that from a compliance perspective, there's no going back. That people will need to spend on data protection, privacy, etc. And so I agree that there's nothing that you can do. These are essentially fixed costs in a lot of respects.
Thanks, guys. So we're going to move on to question 5. Now, this is a bit of a build on question 3. It's a broader question. So how can technology drive digital transformation to deliver cost containment objectives? I guess the first point there would be those objectives. But John, I'm going to let you kick off on this one, and then I'll come in.
Well, you know, I've been kind of engineering and helping organizations through back office transformation, like I said, you know, over 10 years. And technology is a key component to it, now more so than ever. There's really no such thing as just re-engineering a process without some technology component. So it has to be present, but it has to be sort of seamlessly integrated, the technology and the looking at processes end to end, trying to remove these functional silos that we've had for so long and really breaking those down so we're more solution oriented, no longer having this IT group or IT department dictating the tools that we're going to use and trying to push that to stakeholders and business users. It's got to be reversed. It's got to be our business users really informing the enabling technology that they need and trusting that IT will help bring it to them and working collaboratively together. I mean, we've seen examples of that, but to me, at least in my experience, it needs to happen more often to really get the full value of seamlessly combining, the process with the org and the technology to have truly transformational impact.
Yeah, I think your point there about the boat, and there's always that question of build or buy. I think IT departments can get to a point in their life cycle where there's a confidence about wanting to build everything, and in some cases that makes sense. But in a lot of cases, there's such good technology out there that the buy question should be further analyzed. Although you have that kind of political dynamic going on, which can also tend to hinder digital transformations. I think a lot of this is to do with coming right back to even Management 101, where you step back and you look at how things are running today, you map that out, and you figure out where we can actually utilize or leverage technology, and then go and do your explorations. What is best of breed, figure out that whole question of build or buy, and then look at what the budgets are to do that. I think in today's environment, given what's happening with the economy and this kind of economic uncertainty, the low-hanging fruit, we talked about just dragging costs out of the process. That's one thing. That's survival. In terms of how you then continue to drive costs away from the business, but then leverage technology to regrow your business from where it is today to where you want to take it. I think this is how companies need to do a much deeper dive in a more collaborative fashion than, as you said, letting the IT department dictate what's going on. And some companies that works out really well, and a lot of companies I've seen it not work out very well. John, I know you do a lot of consulting work and you go in and you do these deep dives. We get involved in that to some extent, probably as an adjunct, as the next level beyond that first analysis, but we see a lot of cases where there's some very bad decision making going on. I think the starting point is to figure out what those cost containment goals are, and then map it, and then look for what are the opportunities, focus in on those, build or buy. Do I have the budget? Does it make sense? Is it going to deliver my cost benefit analysis and my ROI that I'm looking for? And then set out your stall to those things. So again, I mentioned management. This doesn't sound like rocket science, and it isn't. But you'd be surprised how many companies don't spend the time to stop, take a breath, and actually look at their operating models in such a way. And I think it's in economic times like these that we find there's more of that. I can certainly tell you that my funding boxes did fill up a lot quicker in the last month than it did do before that. I don't know if that is economic that's driving that, but I suspect that it is. So a little bit of flavor of what happened after the global financial crisis. We saw the same thing then. So I believe we're seeing a repeat of some of this now. And Josh?
Sure. I don't think I have anything else to add on this one, but I'm sure that people are using the cloud and they're using mobile devices and thinking about what they need going forward, and so I'm sure there'll be pressure to make things even more user friendly.
Thanks, Josh. So the last one is, which areas of the IT budgets will be preserved for cost containment? Well, I think that relates a lot to, I'll kick this one off if you don't mind. This relates a lot to, I think, question 5, and that is, have I done my homework to figure out what budgets that I should be allocating to what opportunities that are going to drive not only my cost containment goals, but obviously coming out the other side. To me, I don't see a difference between cost containment as a goal and driving my, to me, they go hand in glove. Because if I'm not operating an engine in my own shop, then I can't attain or achieve those goals that I want from my business. So to me, it should be a constant review. It shouldn't take a global financial crisis. It shouldn't take a pandemic where we have economic stress fall on us so quickly for us to start looking at these things. I think this should be a constant focus. I think it should be something that should be a high priority on most C-suite level management of funds and fund administrators and others that serve the industry, to continue to look at this all the time. And it's kind of like in good times when our cups are overflowing and profits are running in, then we'll tend to spend time looking at how we operate. We're more focused on the front end, driving new business. And I get that, but I think the two things should go hand in glove. For me, I think that the focus on what should be preserved should be the areas that, number one, deliver the biggest ROI and the biggest cost benefit. And those would be those that I, so I'm containing costs while I automate, bring in technology that's going to take out very efficient, but those things are leveraged, as we talked earlier about, to help me drive my business. So those are the areas I would focus on. And then things like vendor lease renegotiation, these all help me to have a very solid or low operating cost base, and therefore I'm going to help to improve my margin. And if I want to pick on fund admins again, I'd say again that fee compression from the top is going to drive them to look very closely at this, certainly in the next few months, because that pressure is absolutely coming down the pipe for them. So John, can I ask you to come in over the top of that?
Yeah, the only thing I'll add is just, I mean, Gary, you said the last question is taking the pause, whether that's 1 hour or 1 week, 1 month, to really evaluate what do we need when this turns around to hit the next growth cycle running, and de-investing in some, strategic spend categories like IT, like skilled labor, that there is no ROI. There's negative ROI. That's going to dig us in a hole that is going to be very difficult and expensive to get out of, because we can be sure that, there's other enterprises and competitors out there that are investing in these things like intelligent automation and being able to have that digital collaboration and advanced analytics, and having those in place, even if it's not major investments, but making sure we're moving forward on some of those things, it's going to just position us for the next growth market and not kind of, hamper us from really taking advantage of when things start to turn around. And we know it is, whether it's next week, next month, or year, it is going to be turning around. So having that plan in place and make sure we're not, digging ourselves in a trench because we're trying to save a few bucks, I think is a strategy that needs to be addressed and really, thoughtfully planned out.
Fantastic. Thanks. And Josh, have you got anything to add on top of that?
I just would note that as mentioned, there are a lot of firms that are going to be suffering from reduced AUMs, and so a lot of firms are going to be reevaluating their entire business plan over the short term. And I'm sure that the technology discussion is front and center to all those considerations as to what the business plan and business model is going forward.
Cool. Well, we've closed out our 6 questions in a good timely fashion. I know we had a little bit of delay at the beginning to start the meeting, but I certainly want to thank John and Josh and everybody for participating. We do have a few moments for any additional questions. I hadn't seen anything come in on the chat box, but I don't know, Josh, if you have any additional points that you wanted to provide our group today.
Just a final point would be that when thinking about cost containment, just be creative and look around. I think that there are solutions, both technology and outsourcing, as well as people who are now entering the workforce without jobs or in the workforce and have been laid off. And these people are great resources. And so I'd say think creatively about whether some of those people might be appropriate to bring in-house or to employ on a temporary basis. So I'd say to keep in touch with your peers who are going through the same thing, and hopefully there are solutions out there that will help firms transition to whatever comes next.
Interesting, yeah, the new normal, whatever comes next. And John, have you got any additional points?
And I just iterate what we've all this said already is, be strategic, look ahead, be opportunistic, eliminate the low value spend that we all know is out there. This is the time to really, clamp down, have the visibility and go after it, but also be opportunistic in investing in the things that are really going to help propel us in the next growth cycle.
Yeah, I'll mimic those fine points as well. You can panic, you can knee-jerk, you can lose some very good resources and skill sets that you built up over the years out of fear of a potential economic downturn. So I know a lot of companies that have been looking at their different teams and managements, and looking at those that they would need to retain all those skills and make sure that their business can come out the other side of this. Very painful times for a lot of folks. I'm sure everybody on this call is familiar with people that have been impacted to a lesser or greater extent here. But coming back to the funds industry, again, I do think it's time to start looking a bit inwardly here about how the model can remain stable, how we can support the funds industry, how we can support those vendors and suppliers, leveraging technology and making sure that we're doing all that we can to be as efficient as we can. It's a constant. This is never going to change. People talk about, let the dust and I'll get. And you hear that all the time. Let me get past, and then we'll finally take a look at this. Those realization moments tend to only come when we have a brick wall that we get faced with, like we're getting faced with now. I don't know what the new normal is going to look like. I do think that perhaps a portion of the workforce will not return to work because they don't need to. Like, we're all working from home and we're safe and we're well and we're able to function like we are today and meet today, which is fantastic. I just want to say again, thanks to my co-panelists, and I want to say to the HFA for the opportunity to put this webinar on. I hope that the audience found it valuable. We're able to provide a copy of the deck, which includes some additional supporting material and research and some detailed bios of the panelists. But thank you all for today, and we'll say goodbye. Thank you so much.
Thank you.
Thank you.